I've been thinking about this non-stop, and I'm finally recording it late at night on January 25th, 2026, because the signal got too loud to ignore. If you're here from the OG community, I see you. The love on Ninja Episode 4 and the recent drops has been unreal. I read the comments, all of them. No cap. And yeah, I'm cooking up upgrades behind the scenes to level us up together. Quick housekeeping before we get into the real stuff. If you haven't joined the WhatsApp channel yet, it's in the description. It's free, and we vet everyone. Because scammers move like roaches the second momentum shows up. Approval can take a minute. That's on purpose. And hear me clearly. I will never ask you for money. I will never pitch you a private play. I will never DM you about wallets, links, ops, or anything like that. Zero. If somebody hits you pretending to be me, block them and report them immediately. Protect your energy and protect your bag. The internet is full of wolves wearing creator masks. Now let's talk about why I'm even up at midnight. Because a billionaire precious metals legend just went on record and said something that made me sit up, pause, and recheck everything. Eric Sprott, a guy who's been in this game longer than most of us have been alive, basically looked at the entire silver junior mining space and said, in plain language, I own every silver junior there is. Everyone. Not a basket, not some of them. All of them. And then he said the quiet part out loud. At $150 silver, these stocks can go up 10 times. That's not a casual statement. That's not a throwaway line. That's a man with decades of pattern recognition making a very loud bet, publicly, on a sector most people still treat like a graveyard. And what matters isn't just the flex of, I own them all. It's why he believes they're overlooked, why he believes the pricing structure is breaking, and why the leverage inside these juniors might be the most mispriced thing in the entire precious metals universe right now. Let me connect the dots, because this goes deeper than one billionaire being bullish. What Sprott is really describing is 3 big structural shifts happening at the same time, and when you stack them on top of each other, the picture gets kind of insane. First shift. The paper pricing machine is losing its grip. Second shift, capital allocation could flip in a way that breaks our mental model of what silver should be priced at. Third shift, the junior miners are still valued like none of this is real, even though the metal is already in a different universe. Start with the idea of control. For years, people have watched gold and silver and said, it's manipulated. Some of that conversation gets messy because people treat it like a conspiracy vibe. But what Sprott is pointing to is more specific. The mechanism that allowed paper claims to overwhelm physical reality is under stress. The system where you can sell a mountain of paper contracts on a limited pool of real metal only works as long as nobody demands the real thing at scale. The moment physical demand tightens and delivery becomes the issue, the paper game doesn't look like price discovery anymore. It looks like a bottleneck that can snap. He's basically saying gold crossed a line when it broke through a major level back in 2024, and the banks that had been leaning on it couldn't keep doing the same routine. Not forever. And he's saying silver is now doing the same thing. There's a magic number moment in markets like this where the tone changes. Maybe it's $35, maybe it's $40, maybe it's a different threshold. But when the flow flips from paper can overpower everything to physical demand is calling the bluff. That's when the whole psychology changes. That's when you start seeing the day-to-day tape and thinking, wait, how are they actually going to meet this demand if people keep pulling metal out of the system? And silver is uniquely positioned to be the pressure point, because it's not just a shiny monetary metal people stack in safes. It's also industrial oxygen, solar panels, EVs, grid upgrades, data centers, AI infrastructure, 5G equipment, military and aerospace applications. It's everywhere, hiding inside the machines that run the modern world. Gold can sit in vaults for centuries and still be gold. Silver gets consumed. It gets used. It gets scattered into tiny amounts across billions of devices. That matters because it means shortages in silver don't behave the same way as shortages in a purely monetary metal. When industry needs it, they don't care about your feelings. They pay up, or production slows. Now layer in the second shift, allocation. This is the part most people aren't emotionally prepared for, because it's not about, will silver go up? It's about what happens if big money changes its default settings. Sprott floated a model portfolio idea that's basically a mental grenade. What if institutions moved from the typical tiny precious metals exposure to something like 20%? Not as a meme, as policy. As a "this is how we survive a new monetary era" strategy. The standard portfolio world has been trained to treat precious metals like a decorative side dish. A little hedge, a little insurance. But if the world is shifting into more inflation volatility, more geopolitical fragmentation, more currency distrust, more debt stress, and less confidence in risk-free assets, institutions may be forced to take hard assets seriously again. And here's the brutal math. Silver is not a deep liquid market compared to the capital pools that could flood into it. If a meaningful slice of global institutional money decides it needs more hard asset exposure, silver doesn't politely adjust. It gaps, it jumps, it becomes unrecognizable. Because the market is too small to absorb that kind of demand at current price levels. That's why Sprott can say something that sounds crazy, like, you might not recognize the price, or even throw out numbers that make people laugh. The laughter stops when you run the basic supply and demand logic. If demand grows faster than supply, price has to do the violent work of rationing. There's no other mechanism, and that brings us to the third shift, the juniors. This is where the leverage lives, and also where the mispricing gets offensive. Because even if you don't buy every macro point, you can still see this disconnect. The metal can be screaming higher, while the small mining companies that theoretically should be the highest beta leverage are still valued, like we're living in an old regime. Think about what a junior miner actually is. It's a claim on ounces in the ground, plus the probability that those ounces become economically extractable, plus the credibility of management, plus jurisdiction, plus financing risk, plus time. Juniors are messy. They're not a clean, silver goes up, stock goes up machine. But that's exactly why, when the market reprices them, it can happen explosively. Because people ignore them, then suddenly the narrative flips, then suddenly the liquidity rushes in, and the same companies that were dead money become the only game in town. The core concept Sprott is leaning on is the mining margin curve. When a commodity price moves up, the economics of mining projects don't rise linearly. They can go exponential. Costs don't instantly triple just because the metal price tripled. A lot of costs are fixed or slow-moving, so a project that looked barely viable at low prices can become a monster at higher prices. The net present value can change dramatically with relatively small moves in the underlying commodity. That's why people say miners are leverage. It's not just a metaphor. It's how the math works. Now imagine a junior sitting on a deposit that's meaningful. tens of millions of ounces, in a decent jurisdiction with real studies behind it, still being valued by investors who can't stop anchoring to an older price regime. That anchoring is powerful. Humans do it. Analysts do it. Fund managers do it. They build models with assumptions that feel normal because that's what they've lived through. And if the regime has actually shifted, those models become outdated while everyone still pretends they're reality. That's the window where asymmetric opportunities are born. And to be clear, the reason so many people are asleep at the wheel is emotional scar tissue. Silver ran hard in the 2000s and peaked in 2011, and then the sector got absolutely wrecked. A lot of retail investors got smoked and swore they'd never touch it again. Institutions spent a decade chasing tech and growth, treating commodities like an embarrassing relic. ESG pressure made some funds hesitant to touch miners at all. And now, even as the world gets more resource-constrained and more inflation-sensitive, a lot of capital is still positioned like we're in the same low-rate, easy money era. That psychological lag is exactly what creates these valuation gaps. But let's keep it honest, because if you've been with me, you know I don't do fantasy land. This isn't guaranteed money. Juniors are high risk. Some are run by promoters who can talk but can't build. Some have ugly share structures and can dilute you into dust. Some sit in jurisdictions where rules change overnight. Permitting can take forever. Financing can be brutal. Even in a bull market, the path is not smooth. Silver can rip 30% and then drop 20% like it's nothing. And miners can drop twice as hard. If you're emotionally fragile, over-leveraged, or gambling rent money, this sector will punish you. And here's the one nobody wants to admit. You can be right and still suffer. You can be early. Markets can stay irrational longer than people can stay solvent. A thesis can be correct and still take longer than you want. And if you size it wrong, you'll tap out before it pays. That's why discipline matters more than hype. Patience matters more than tweets. Position sizing matters more than conviction. Because conviction without risk management is just a fancy name for getting wiped. So what do you actually do with this information if you're watching and thinking, okay, this is interesting, but I'm not trying to YOLO into speculative miners like a maniac. You build a foundation and you stack exposure in layers. First, educate yourself from primary sources. Don't rely on clips. Don't rely on someone's hot take, not even mine. Read and watch the full interviews, the full context, and understand what's actually being claimed. The more emotional a market gets, the more important it becomes to separate signal from noise. Second, understand the concept of core versus leverage. If you believe in silver long-term, physical metal is the base layer for a lot of people because it has no counterparty risk. It doesn't care about management decisions, dilution, permits, or financing. It just exists. That doesn't mean you have to buy physical. It means you should understand the role it plays in a risk framework. Third, if you want the leverage, treat juniors like what they are. A high volatility satellite position. Not your whole identity, not your entire portfolio. You don't swing for 10x with money you can't afford to lose. You allocate in a way that lets you survive the inevitable drawdowns without panicking, revenge trading, or selling the bottom because your nervous system can't handle the red. Fourth, do real due diligence, not vibes, not a ticker someone shouted on social media. Look at the management team's track record. Look at where the asset is. Look at the resource size and grade. Look at how they've financed themselves historically. Look at dilution, look at cash runway, read the technical reports when available. The difference between a legitimate junior and a promotional trap is often sitting in plain sight for anyone willing to do the work. Fifth, have a plan for taking profits, because greed is how people turn winning trades into tragedies. If something goes parabolic, you don't have to sell all of it, but you should consider scaling out, rebalancing, and protecting yourself. In volatile sectors, gains can evaporate fast. Acting like this time is different without a strategy is how people end up round-tripping life-changing money back to zero. And lastly, keep the macro in mind, because metals don't move in a vacuum. The world is dealing with massive debt loads, persistent inflation pressure, supply chain fragmentation, and a growing desire by nations to diversify reserves away from a single currency system. When trust erodes, hard assets become less of a niche hobby and more of a serious allocation debate. You don't need to predict every headline. You just need to recognize that the environment is more supportive for commodities and monetary metals than it was during the infinite liquidity, stocks only go up era. Now zoom out and consider what Sprott's posture actually communicates. Whether you agree with every detail or not, the meaning is clear. Someone with a long track record believes the silver market is structurally tighter than most people think, believes the pricing mechanism is under stress, and believes the juniors are still being valued like the old world is intact. That combination is exactly where massive repricings are born. Not because the universe owes anyone profits, but because markets hate being wrong for too long. When a narrative shift meets a supply constraint and a capital rotation, the move can be fast, ugly, and vertical. And if you're wondering why I'm emphasizing the scam warnings and the "don't get reckless" message so hard, it's because this is the kind of environment where fraud thrives. When people hear 10x, their brains turn off. They stop thinking. They start chasing. That's when the fake accounts show up. That's when the "send me crypto to get access" nonsense appears. That's when people get tricked into connecting wallets, clicking links, and handing away control. Don't be that person. Stay sharp. If you're still here, and you've actually been locked in, drop a comment with OG John AG, or just OG at the end. Not because it boosts my ego, but because it tells me who's really paying attention and who's here for the long game, not just the dopamine hits. And let me leave you with the real takeaway, without turning it into some corny checklist. The idea on the table is simple. If physical demand continues to tighten, if capital allocation shifts even modestly toward precious metals, and if the junior miners are still priced like none of that matters, then the gap between price and value can close violently. That's where the asymmetry lives. The risk is real, the volatility will be real, and the timeline is unknowable. But if the underlying conditions are shifting the way Sprott suggests, then the long-term pressure is not coming from hype. It's coming from reality. This is not financial advice. This is information and commentary for you to verify, challenge, and use according to your own risk tolerance and situation. Do your homework. Size responsibly. Don't gamble your life. Invest with logic, not adrenaline.